Welcome to the Canadian Investors course, Session 2, Income Investing Commentary. Please read the terms of use and disclaimer slide on slide 2 of this slide deck. This commentary will cover bond market potential danger. The comment, it's really different this time. The thought that you should understand what you own, don't become a pie chart victim, and rate reset preferred shares. Bond market potential danger. The great advantage of bonds has always been price predictability. It's about math. If you buy $100,000 of a 10-year bond for $100 with a coupon, that is the interest rate of 3%. Let's see what happens if if interest rates either go down to 2% or up to 4%. At 2%, in other words, if interest rates drop 1%, the $100,000 bond could be sold for $109,020. If interest rates went up 1% to 4%, the $100,000 bond would be sold for $91,825. In other words, a capital loss of a little over $8,000. Obviously, the gains and losses described in this scenario would be magnified if the term of the bond were even longer, say 20 or 30 years. Let's explore the comment, it's really different this time. The 2008-2009 global financial crisis left a huge overhang of unusually low interest rates. Huge capital gains were earned since 2008 as a result. So where do we go from here? Why, for example, would you buy longer maturity bonds now? So let's look at the math. If you take government bond yields today and compare them to those yields in 2008, so let's say today is August 2016, so that we got a benchmark. And if we were looking back to 2008, a 5-year government in Canada today is paying, well, in August 2016 was paying 0.58%. In January 2008, it was paying 4%. A 10-year is paying 1.05 in August 2016. In 2008, it was paying 4 as well. A 20-year, 162 today, 425 in 2008. 30-year Canada, 218 today, 475 in 2008. What does this mean? Well, if you bought a $100,000 30-year Government of Canada bond in January 2008 and sold it in August of 2016, it would have sold for $156,370. And that doesn't include the interest received. That's a capital gain of $56,370, a wonderful rate of return. So how did bond funds perform over the same period? Let's look at the next slide and use the BMO bond fund as an example. It's a typical bond fund you can buy at a bank. As you can see, over that same period of time, that BMO bond fund had a wonderful run from 2008 till today. Now, let's compare that to a 10-year Government of Canada bond yield. Well, as Government of Canada 10-year bond yields fell, so you'll notice that the BMO bond fund went up in value. But look at where the yields are today. Let's look at, for example, a 5-year Government of Canada bond yield too, just as a comparable. Well, predictably, they were very high in, as going back all the way to 1982. Now they're super, super low. In fact, they're so low that they're lower than the depression rates of the 30s. So how would you feel about locking in to this 5-year Government of Canada bond at this super low rate? Does that seem like a reasonable thing to do? Now, this brings us back to that pie chart that I asked you to fill out and maybe talk to your trusted wealth professional about. So, which one's which? Well, The first one, with 45% fixed income, in the world of pie charts would be considered to be a balanced portfolio. The second one, with no fixed income at all, would be considered to be an aggressive growth portfolio. The third one, with almost 3/4, 65% fixed income, would be considered a conservative portfolio. That's the kind of portfolio that might be sold to your grandmother because it's supposedly conservative. And the fourth one, with 30% fixed income and 25% each spread over 20 to 25% each spread over the various forms of equities, would be considered a growth portfolio. These are the official answers that Canadians are subject to from the banks and many advisors. But now that you know how a bond works and understanding what's happened to current interest rates, would you call the conservative portfolio conservative? If this is a concern to you, it's probably time to revisit your asset mix and your portfolio. Maybe you may want to learn something more about these, and you may want to talk to your planner or advisor about your holdings to see if you're comfortable. If you're not comfortable with the response you get from your planner or advisor, that might be a good reason to try and contact a trusted wealth professional through this program. Let's look at another way of looking at fixed income, and that's rate reset preferred shares. First of all, what are preferred shares? Well, they're shares that are a form of corporate debt. They're not common stocks. In fact, they stand in preference to common stock, meaning that they receive a dividend before the common stock can. Preferred shares are typically issued around $25 a share. Typically, they pay a set quarterly dividend, and in the case of rate reset preferreds, for a period of typically 5 and in some cases 6 years. And at the end of that period of time, one of two things occurs. Either the issuing company buys back your shares for $25, or the dividend rate can be reset. Now, the new dividend will be reset at a preset number, which was established when the preferred share was issued, plus whatever the 5-year Canada rate is at that time. So let's take an example of a bond that was issued between 2008 and now by a major Canadian bank. It was a rate reset preferred, and it issued for $25. It had a 5% yield guaranteed by the bank for 5 years. After that initial 5-year period, the bank had the option to buy the shares back from you for $25, or they could reset the yield at 4.5% plus the 5-year Canada bond yield at that time. So let's suppose the 5-year Government of Canada bond yield at that time was 2%. So that would mean that 5 years from now, the new yield would be 4.5% plus 2% is 6.5%. This example reflects an actual preferred that was issued in 2016. It's great for investors that need income. This income investment also offers a dividend tax credit to keep even more after-tax dollars. Since you received a dividend and not an interest payment, it gets the dividend tax credit means that you're taxed at that preferred rate. So you get a good quality investment, in this case with a P2 rating, with more than double the after-tax income of a 5-year GIC, and with protection from rising interest rates in the future. Is this something that might suit you? If this is enough of a predictable return, then why would you want to take more risk? Now you're educated. If you like and are intrigued by this and would like to know more, use your postal code indicator on the website to find a trusted wealth professional who can buy rate reset preferred shares for you for your portfolio. Knowing how to find the right rate reset preferred, which is safe and suitable, is very important. This is the end of the commentary for session 2.